Hello everyone, welcome to the Python Invest YouTube channel. Today we will talk again about portfolio optimization. This time it will be all-weather portfolio by Ray Dalio and adding some new stuff like crypto coins. So what we're gonna do, we'll start from data imports, downloads and tooling. We'll use Yahoo Finance library to get daily stats on all ETFs. Then we will use riskfolio-lib and vector BT libraries to analyze portfolio performance and find optimal combinations of portfolios. It's not easy to import all these libraries in Google Colab because of the dependency management, but you can do it in a simpler manner if you do a local environment and write down all needed library versions explicitly. So when all libraries are imported, we will analyze a classic all-weather portfolio. So we will replicate this portfolio with just 5 ETFs, and we'll see how it performs over the period of several years. Then we will try to optimize weights for the classic all-weather portfolio on some period of time and build an efficient frontier. So we will introduce the risk-return notion concept, and we'll show how to operate with these new definitions. Then on top of it, we'll try to add Bitcoin, and we'll prove that if you add even a small portion of crypto coin like Bitcoin, you can considerably improve portfolio characteristics. And finally, we will add more cryptocurrencies. That will be 7 additional cryptocurrencies to be added to the portfolio. We will improve some of the portfolio characteristics even further, but not all of them. So you can read the full article on our website, pythoninvest.com/longreads/all-weather portfolio with crypto. And please, if you like this content, support us on Buy Me a Coffee or on GitHub sponsorship. The links are provided below. So first, let's start from libraries imports. We import Y Finance, some other classic libraries like Pandas and NumPy, and then when we import riskfolio-lib, you can see that there are some problems with the versions of a NumPy library, and you'll need to reload the environment so that an older version of NumPy is installed and riskfolio-lib is imported properly. Then when you run it again, you will again see some message on now connected with the vector BT library, and I suggest not to reload the notebook and just close that window and run it till the end. You can check that if these imports work well, import vector BT and import riskfolio-lib, so then you can run all the code successfully with no problems. So now we define some time scopes for our study. We start from 2010, so we will look at the last 15 years. We will use the first period of time from start to middle, from 2010 to 2018, to optimize weights when we find optimal combinations of weights for Sharpe optimization. And then after it, from 2018 to the latest date, which is mid-October 2024, we will see how our portfolio performed. So first things first, our classic portfolio consists only from 5 ETFs or assets, which is gold, GLD, GSG, IEI, TLT, and VTI. So when you download these assets from Yahoo Finance, you will see numbers like this. We are interested only in adjusted close prices, and we define standard weights on these assets: 7.5%, 7.5%, 15%, 40% and 30%. So if you visualize, and this is the first good benefit of using a riskfolio lib, you can have a really nice visualizations just out of the box. You can see that stocks are represented with VTI, and it is 30%. Then bonds, which is intermediate and long-term treasury bonds, US Treasury bonds, which are TLT and IEI, and they represent approximately 40 plus 15, 55%, and the rest 15% are on commodity golds and commodity diversified index. So you can calculate manually without vector BT or any other libraries the returns, and you will get that in 7 years from 2018 to 2024, and the growth was 43%. And if you want to get other portfolio characteristics, now you can use vector BT library, and you can get that this total return of 43% is actually 5.4% annual return with a compound interest over 7 years. You can calculate analyzed volatility 9.2%, maximum drawdown 22.8%, and some other characteristics like Sharpe ratio 0.6 and Sortino ratio 0.86. So then next idea is that what if we want to optimize this portfolio? And when I tried to run this code last year, I got better numbers for Sharpe optimization, and this portfolio was better. But now when I look again, actually classic weights are delivering better results. But still, let's try to do this. We have the same asset classes, and we download the data again. We define 2 periods of time, and first period of time before a middle date before 2018. We can optimize with a classic portfolio optimization method, so you can read about it at the library page, and you can read about these models and parameters. What are we going to optimize? I can say now that we are optimizing Sharpe ratio, which is expected returns divided on the risk. And if we optimize this, the weights are quite different. So we don't have all 5 assets included to the portfolio now. We have a totally different combination. Say VTI, which is stocks, is down from 30 to 24%. Bonds are up, TLT and IEI, probably because of stable growth and high rates for that period of time. So now we can think about what if we want to take more risks on us. So what if we want to get more return? And that's how we come up with this efficient frontier idea. That if we take more risk on a horizontal axis, we might have higher expected arithmetic return, and that's how we have our frontier. And the problem is that the standard deviation of a risk is growing faster, and your expected returns are growing slower, so that if you divide returns on a standard deviation, your Sharpe ratio will decline if you take additional risk on you. That's why the optimal portfolio for our case is very close to the beginning of the curve, and it is marked with the red star. So we're still quite conservative with the risk, and we get good returns for that risk taken. Next idea, will tell you if you want to look at those 50 individual points of an efficient frontier and how these optimal portfolios are constructed. Essentially, it's the same 5 assets combined together. In our case, when you optimize on Sharpe, you have even less. You have 3 asset classes, and it is stocks, VTI, and 2 bonds, IEI and TLT. And if you want to take more risks, you will have more and more VTI stocks share in your portfolio. That's the green area. So you take more risk with stocks, which is natural. And you can analyze individually and try to understand some underlying mechanics of how this portfolio optimization works. You can try to see the analyzed returns versus volatility for gold, which is just 1.5% per year and 16% volatility. So if you divide 1.5 on 16, it is quite a low number. GSG, other commodities were actually negative for that period of time, so they might be positive for other period of time or longer period of time. So if you change your period, you might get other results. Then bonds are 2.7 for a short term and 7.5 for a long term bonds, which is not bad if you can get these returns over a long period of time. And stocks were 13.7%, which is also a very high growth. And then if you analyze the performance of that portfolio with optimal weights, which is a Sharpe-optimized portfolio with just 3 assets, you can see that portfolio grew only on 32% in 7 years from 2018 to 2024, and with analyzed return just 4.2%. So even if we have slightly better Sharpe ratio 0.72 and slightly better Sortino ratio 1.02, the overall realized return was not good enough over 7 years. Next idea is that already at the beginning of 2018, Bitcoin was present for a few years, since say 2014, and we knew about this phenomenon, and we might wanted to add this to our classic portfolio. So on top of 5 classic assets, we add BTC USD, and we see how exactly the same procedures work. We optimize weights on the data from 2010 to 2018, and this time what we have here, actually the stocks ratio is about the same as we see in the classic portfolio, which is 29.3%, but the BTC ratio is around 7%. So the combined weight of bonds, TLT and IEI is lower now, and part of share is taken on BTC, and we still don't have any commodities, GLD and GSG, in the portfolio. So if you try to build the efficient portfolio, the efficient frontier, it will be like this. The only difference is that because cryptocurrencies are very volatile, you can get a lot of risk, like 50, 60, 70% standard deviation of growth, but you can also get a lot of arithmetic returns up to 120%. So if you want to see how you're progressing with different portfolio combinations when you grow your risk, the idea is similar, that if you want to take more risk, you just need to increase the weight on BTC USD, on cryptocurrencies in your portfolio, that is the blue area, and you will receive more risk, but maybe expected return won't grow that fast. So again, the optimal value, the Sharpe optimized value, is somewhere in the beginning. That is probably 0.3 or 4. And if you check here, the combination will be a bit of Bitcoins, which is 7%, a lot of stocks, which is VTI, which is 30%, and the rest are on bonds, which is a pretty balanced classic portfolio with a bit of exposure on cryptocurrencies. So, and now you slightly change the portfolio, but the total returns are completely different. In 7 years, you could get 69% return, which is 8% annualized return with a 0.88 Sharpe ratio and 1.23 Sortino ratio. There are other portfolio characteristics you can consider looking at, but I will focus only on this. And finally, we want to compare all those portfolios on the one graph. And you can see that the original portfolio all-weather weights, which is a blue line, was growing from 2018, which started from 100%, and it was growing and going down through the whole period of time for 7 years. The Sharpe-optimized portfolio for the same all-weather assets is a red line, and it was almost all the time below the blue one, so it was not actually better in any sense of returns than the classic portfolio. But the green line, it started not very well in 2019 and 2020, but all other years, because of a small share of crypto, Bitcoin, it grew faster, and this growth even accelerated in the last 2 years. The gap is bigger between classic portfolio and portfolios with crypto, and so we can compare the stats of these three portfolios together. But before doing this, let's finally add more assets, which are top 8 cryptocurrencies. On top of BTC USD, we add some other cryptocurrencies. So all of that you can get from Yahoo Finance. You can see that the volume of trade is quite different. For these currencies, it is dominated by BTC and Ethereum, but some other currencies may be very important for our optimization. The intuition behind it is that some of those currencies are actually quite not correlated with Bitcoin. So if you already have Bitcoin in your portfolio, you may not want to add, say, Ethereum, which is 92% correlated, and it moves in the same direction, but maybe you will add XRP because it's only 43% correlated, and it will give you an additional growth or decline resistance in bad times for the portfolio. And so if you try to find the optimal Sharpe composition, the weights will be like this. So BTC will be now less, and then 7%, it will be 3.5%. We will see now some of the commodities, which is gold and GSG, 6% and 17%. A bit of bonds, which is TLT, and more stocks, which is 69% of VTI, and 2% on XRP. So now it's much riskier portfolio with more different assets, and again we can build the efficient frontier, and the risk will be very, very huge if you go further right to the right corner of the graph. It can be like 600% or 700% on the standard deviation, while expected return can be quite big as well. The combinations of different efficient portfolios can be quite different depending on the risk you take. And now the riskiest coin is probably ADA USD, this blue line, but we will be interested in the very beginning of this efficient frontier in the combination of weights that we showed before. So now if we compare 4 portfolios, so we have the same 3 portfolios in the beginning, and we add the purple line for this Sharpe-optimized portfolio with 8 cryptocurrencies, it can go lower than all other portfolios, but it can go up compared to all other portfolios as well. And in the last 4 years, this gap is actually widening between these portfolios. So, and finally, we can have a one single comparison of 4 portfolios: all-weather classic, weights, Sharpe-optimized, Sharpe with BTC, and Sharpe with 8 cryptocurrencies. First that I will look at, first metric that I'm looking at is total return. So it can vary from 32% to 142% in 7 years. Then I'll look at the volatility and analyzed return. So how much do we actually have in 1 year, between 4, 5 and 14%. But I will also consider looking at the maximum drawdown. If I have a big capital accumulated in my portfolio, I don't want to lose 33% in a maximum drawdown, even though the maximum drawdown duration is much lower than for other portfolios. I would better choose something less risky, say a Sharpe Ratio Optimized portfolio with BTC, which is just 24% maximum drawdown, with a good Sharpe ratio of 0.88 and Sartino of 1.23. So it's up to you what you want to choose for your personal investments. In this video, we looked at the code, how you can do portfolio optimizations for any set of stocks, bonds, and ETFs of your choice. And you can replicate this code for the portfolio of your dream. Thanks for watching this video, and see you again next time.